particularly difficult time back then, what made life especially difficult was the fact that there really wasn't much in the way of economic data that could be that could be gleaned. So just as everybody else was struggling with jobs and finding their feet and being able to deliver on productivity, etc., so too were the statistical officers that weren't able to accumulate the amount of data required to be able to feed us back the usual set of data that we would typically utilize to understand what's going on in the economy. Thankfully, we've now progressed through that, and some of the data is starting to come through, and finally we've got some perspective on how this economic recovery is going to look like. And the theme of today is whether it's a V, a U, or W, or whether that even matters in the broader scheme of things when we are considering what the ultimate response is going to be from both the fiscal and the monetary authorities, and just how powerful that has been, and whether or not it's been able to offset all the impacts that we've seen so far. So without further ado, I'm going to jump into the first of our slides, and typically we try and find some perspective on what's happening in the real economy. By real economy, I'm talking about the productive sectors, not necessarily the service sectors, although I'm not suggesting they're any less important. But it's the primary sectors that are effectively your big engine to any underlying economy. And so it matters whether or not those have recovered to any sense of normalcy. It also gives you a sense of what global growth dynamics look like. Now, the chart on the left is a fairly broad-reaching chart giving you the various official PMI surveys of China, US, the world, developed markets, emerging markets. The chart on the right, a very similar picture, but more of a private sector services PMI reading. So you've got a collection of both, the productive sector on the left, the services sectors on the right. And what's very clear is that in both cases, we've seen a material rebound in activity, both at a primary sector and at a tertiary sector within the economy. That's good news. Now, that in itself doesn't tell us that this is a pure V-shaped recovery. Remember that this is a diffusion index. So we dipped all the way down to 35 in some instances on the services index, down all the way to 15 in the likes of the euro area. So some devastating numbers that came out there. We've only just crept back above the break-even 50 numbers on both scales, which means to offset what we saw as a huge contraction is going to take many months of numbers just above 50 before we get close to pre-COVID levels. So just a little bit of a sanity check on how we should be analyzing that set of data. But looking more broadly at leading indicators versus GDP, here again, we're seeing a good rebound starting to materialize. That would be the blue line. So our global composite leading indicator has bounced back quite strongly from its lows. It suggests that the GDP number, which tends to lag it by a quarter or two, is going to bounce back quite strongly as well. So there again, we're talking improved data, vastly improved data. But please note that we on the blue line, which is on the right-hand, on the left-hand axis, we haven't gone back to the break-even 100 index level. So we're quite far away from where we were. It will still require another 3 to 4% worth of economic rebound for that to materialize. GDP growth, obviously, at this point in time, has got a long way to bounce back before we get to zero. But we think we'll see that in the third quarter and fourth quarter of this year. Sometimes looking at GDP numbers in nominal terms brings home the point a little more strongly. So sometimes looking at growth and seeing that growth has rebounded gives people a sense that everything's okay again. And in fact, it really isn't. So the blue line in this particular chart is what's happened to global GDP. It has quite literally dropped off extremely sharply in a way that I've never seen before in all the data that's been kept by the World Bank, which goes back almost a century. So we've got a very sharp retreat that's materialized. The rebound is going to happen broadly in line with what I've got there insofar as the arrows are concerned. But if you're looking to see how long it might take for global GDP to get back to pre-COVID levels, which is the dotted horizontal line, you can appreciate that you work your way all the way through 2020, 2021, and it's only in 2022 that you get back to those sorts of levels. And that's assuming the trajectory that we are. As you can see, the gray arrow is rising, but parallel to the red, which was the existing trend prior to COVID. Whether or not you ever bridge that gap, I guess time will tell, but it would take a very, very long time. What we would be assuming is that the global economy would somehow discover the ability to generate more growth than has been the case historically. I would say that that's quite a tall order if one considers how much debt has been taken onto government, household, and business balance sheets, such that it will need to be paid down in order to make it a little more sustainable. So some permanent damage has been done. It's going to take a very, very long time for this ever to get back to that red line trajectory. I'm not saying it's impossible, but I think it's going to be a long, hard slog. Perhaps what happens over time is that the global economy becomes more productive through efficiencies that can help bridge that gap. We have seen a lot of sectors already disrupted through this crisis, and it has extracted some efficiencies. The way I'm presenting to you today is a case in point. So it is possible, but it's going to take a lot of hard work, a lot of innovation, and a lot of productivity. Part of the recovery has been engineered by the central banks. We keep very close watch on how they are behaving. This particular chart details a number of your biggest central banks around the world, and you can see very clearly that they've built their balance sheets in order of about $7 trillion through the course of the past 7 months. That's unheard of. It's unprecedented. It dwarfs what we saw through QE1, 2, and 3 back in the days following the 2009 crisis. So this really is a material impact or influence that the central banks have imposed on the global economy. And of course, it is going to have an effect. Their desired effect is to boost a fresh credit cycle. And there are very clear indications that they've been successful in doing so. So regardless of the region that you look at, you tend to find that money supply indicators are turning higher. Money supply indicators are a very good indication of how the credit cycle is starting to unfold. In other words, whether banks are starting to push more credit through the system. That would be a combination not just of final demand and confidence picking up, but also of easy monetary policy that would not just result in encouraging investors and households to borrow, but also in freeing up spare capacity for economic structures that are already leveraged. The ultimate objective is, of course, to try and reflate the global economy. And so we utilize our dollar liquidity cycle as a keen barometer, as a useful barometer to tell us whereabouts in this economic cycle we are. Well, happily, we are well on our way to another boom cycle. We're not far away from the peaks that I suspect that we're going to see, although I think we're going to get to levels of around 13% on a 5-year annualized change period on period. That's a very powerful growth environment. That's a very powerful monetary stimulus environment. And of course, it is going to translate into some booms. It's not all going to be plain sailing. We still know that there are many headwinds to navigate. And so, when you have a look at consumer confidence data from your biggest economies around the world, you can see that they're still in the doldrums. So whilst we are seeing some signs of normalization in economic activity and the shape of the recovery does appear to be, at least at face value, something approaching a V, it's not to say that economic recovery will not be without its challenges. And one of the major challenges is going to be about reversing some of the big impact on things like consumer confidence. Of course, it's not just specific to consumer confidence. It's impacted business confidence and sentiment as well. So there is a recovery to make here, and of course, when one just has a look at how the IMF has been revising down its forecast for 2020, and you'll notice here that we've got a couple of African countries, most notably Nigeria and South Africa, sitting in that red zone where GDP forecasts have been revised down. You get a sense that, well, for the most part, the forecasters had in fact gotten the outlook for the post-COVID world a little bit wrong. They were too optimistic. So 2020, for the most part, country forecasts have been revised down. That balances out a little bit more in 2021. But again, if one has a look at South Africa, it sits on the bottom half of this table. And so Nigeria just slightly above, but closer to neutral. So we're getting more to the point where the dust has settled, and we're beginning to understand the full impact of what's happened. But as we turn our focus across to Africa, it's useful to try and gauge just how big the COVID impact has been on economic growth. Not all the data, unfortunately, has been updated. In terms of by way of example, it's only really been Nigeria and South Africa that's produced Q2 data. The rest of the data for most of the other African countries have been Q1, unless something got released overnight that I'm not aware of. But for the most part, we do understand that there's been quite a negative impact. South Africa, obviously, the worst of the lot, but it's also because South Africa is singularly the most integrated into the global trading system, and it is a very heavily financialized economy that would be subject to some of the vagaries that's impacted some of the developed markets internationally. So we've had big impacts in the likes of South Africa and Nigeria. And insofar as the others are concerned, we do anticipate a knock to economic growth, but interestingly, not as bad as South Africa, and certainly not as bad as the developed markets. In fact, if one has a look at the Economist Intelligence Unit's economic growth rates, I mean, I find it really interesting that even including South Africa into this sub-Saharan African real GDP growth, there's still only drops to around a contraction of -4 in 2020, rebounding back into positive territory in 2021. You compare that to some of the growth rates you've seen in your developed economies, where you're talking about negative growth rates of 10 and -12 odd for the likes of the UK and Europe and even America. And you begin to realize that actually sub-Saharan Africa, relative to what we've seen in the developed markets, has come out of this relatively unscathed. Of course, there are varying degrees of this. South Africa is probably going to produce close to a -10% contraction for 2020, whereas you look at other countries, and whether you look at Rwanda or Tanzania, the impact is far smaller. So we are looking forward to slightly improved economic prospects going forward for sub-Saharan Africa, and that again speaks more to the V-shaped recovery than not. Looking at other sets of data that we can utilize to give us a sense of what that economic recovery looks like, well, thankfully exports, as produced by the World and data produced by the World Bank, which they produce monthly, shows us that exports from sub-Saharan Africa have bounced, and they've bounced very, very strongly back to normalized levels. So that's something to be thankful for. It's been exposure to commodity prices, and China in particular, that has meant that exports have recovered back to pre-COVID levels. the region-wide the regional economy-wide PMI has rebounded back to neutral 50, which is again thankful that we've done that. But again, sub-Saharan Africa appears to have escaped some of the huge impact that we've seen elsewhere in the world. But of course, Africa does have its export partners, one of them being China, which has done really well. The chart on the right shows you that the leading indicators in China have bounced back to fairly normalized levels, and so economic activity in China is resuming quite nicely. Less positive has been what we've seen in India. So India has taken an almighty smack insofar as GDP growth is concerned. And so whether one looks at the leading indicator, which is the blue line, or one looks at the GDP number, which is the red, you can see quite clearly that there's been a massive contraction in GDP, but that the leading indicator is now bouncing back quite strongly. So looking forward, whilst China is supportive at the moment, we believe that India will be. Of course, it goes without saying that when I looked at data from Johns Hopkins University, it was clear that we had a very strong rise in infections. So those infections were rising quite rapidly. Well, now they're leading the world, unfortunately. So India's COVID problem has exploded, and we're experiencing that as we speak. Could I please just ask everybody to mute their microphones, as I'm still getting some feedback on my side, which can be a little bit disruptive. Before year end, we're anticipating that India starts to normalize its economic activity. Manufacturing sector has already come back quite a long way, and that's the COVID infections notwithstanding. So India back above the break-even 50. Of course, it's going to take time for full manufacturing activity to rebound back to the levels seen pre-COVID. And of course, when we look at the chart on the right, imports from Africa on behalf of India have started to rise. This data is a little bit out of date. So this dates back to I think it's the June data. It might be May, but we've obviously had significant improvement in global growth through July and August. September is going to show further improvement still. So we think that blue line on the right-hand side is going to rise quite rapidly. And of course, that's good news for sub-Saharan Africa. So you'll have your two powerhouses being India and China that are going to be performing significantly better than they have up until now. Monetary policy is being deployed throughout sub-Saharan Africa, and that's helped a lot. So again, the purpose here would be to try and create to boost the credit cycle. Some countries have done it a little more successfully than others. Zambia's money supply, I'm afraid, is a little bit too strong for my liking and portends an inflation episode down the line. But insofar as the rest of them, we're getting some reasonably healthy growth rates that are coming through there, suggesting that a credit cycle is going to begin in sub-Saharan Africa as well. But asset prices have taken a knock. And when we look at emerging and frontier markets in Africa, and we look at the MSCI data, there was a big hit. Whether one looked at the broader indices, whether middle large cap or small cap, there was a big hit that materialized through COVID. That hit was also reflected in equity indices that contracted substantially. Equity has stabilized, and they have started to make a recovery. Property, not so much yet. So property will require a resumption in global growth and stronger growth dynamics before that stages a material recovery. But the point is that we often look at financial market instruments to give us a sense of how investors that have got money in the game are seeing the environment at the moment. Now, I guess of the two, the really important chart would be more the chart on the left, and the fact that the investors are seeing improved growth dynamics coming through and are anticipating that the valuations on the charts can now change to become a little more rich than they were obviously post-COVID. We expect that recovery will extend a little bit further and potentially go back to the levels that we saw during 2019. Remember that Africa does not operate as an island. It is also going to enjoy some of the benefits of the massive amounts of QE that I alluded to, insofar as the central banks around the world are conducting. So some powerful forces there that will assist some African asset prices as well. Risk perceptions, as measured by Eurobonds, have improved considerably. So here we're seeing that levels, although they've moderated a long way, they're not quite back to pre-COVID levels, but we're on the way there. And so risk perceptions have improved considerably. As is always the case, there's always an opportunity to be found, and I think it was quite instructive that we found that African bonds, in fact, outperformed even emerging market bonds so far in 2020, and that gives you a sense that, in fact, there is some sorry, I just had some feedback there again. There has been an outperformance from emerging market bonds, and I think that speaks to the proportionately lower impact that COVID has had on some of these African economies, and the probability that there is going to be a recovery that comes through. Of course, some countries, if one has a look at CDS spreads, are more risky than others. And of course, Zambia has had its troubles more recently, but even there, we've had a moderation in credit default swap spreads. Things, in other words, have generally improved across the board, even in your riskier jurisdictions. But South Africa, as one of the big driving African economies, has had its troubles through this COVID crisis. One of the reasons has just been the stringency of the lockdown. So when one has a look at the stringency measure as produced by Oxford University, you see that South Africa ranks right up there alongside the likes of China and India insofar as the lockdown stringency is concerned. And so the impact on South Africa's GDP has proportionately been a lot bigger than it has been for many other African countries that didn't feature anywhere near as high as South Africa insofar as the lockdown stringency is concerned. But some good news is that infections in South Africa, as reflected by the blue shaded blue area, have dropped off significantly, and the recovery rate has risen very, very sharply, all of which means that it's time to open up this economy. And I suspect that we may get a further announcement in South Africa that we'll be heading towards level 1 in the not too distant future. So South Africa's fiscal response has been there, but it hasn't been particularly powerful. In terms of bang for buck, South Africa hasn't done particularly well. There are other countries that have also performed poorly, but where you want to be is in the green shaded area, not the red shaded area. So South Africa's fiscal policy has not been deployed with as much efficiency and effectiveness as we would like to see. There are many reasons for that. Some of them are structural. Some of them relate to the inability for service delivery. But ultimately, I think South Africa wasn't particularly well prepared. And so when you throw money at a problem, but you don't have the structures to be able to deploy it properly, you'll end up utilizing it more inefficiently. And so you'll end up spending more than what you receive in terms of benefit. So it should come as no surprise that South Africa's leading indicator has been under fairly considerable pressure. We recently went into the busting phase, although the most recent data showed a slight uptick. If you want to know why that's the case and why that blue line didn't drop significantly further, well, it really was a function of what the Reserve Bank did and the very strong response the Reserve Bank had to the moderation in economic activity and the risks that manifested. So even in South Africa here, we're starting to see some normalization primary sectors of the economy. There's been a reasonably solid bounce back that we've seen more recently insofar as the July numbers are concerned. We believe that the August and September numbers will be better still. So herein some positive news, but the real problem is the performance of SA Inc. and the inability of South Africa industrial earnings to be able to hold up in such a difficult climate. So there have been margin and earnings compression that has characterized what we've seen more recently, and that's as of the very latest quarter three data. It ultimately means that tax collections for South Africa are going to be dismal. It means that the country's budget deficit is likely to explode, and we think that even these official numbers as produced in the supplementary budget are too optimistic. So we think that budget deficit goes north of 700 billion. And to give you some perspective on what that looks like, Tito Mboweni, the finance minister, spoke about the widening jaws of the fiscal deficit. In other words, expenditure, which is the blue line at the top, remaining buoyant in the face of tax revenues, which has collapsed in a heap. And so you begin to see the depths of the problem that South Africa faces, and why we believe that tax revenues, as reflected by that blue line, are likely to collapse and follow the indications from the SARB's leading indicator. So we think that South Africa has a fiscal crisis to contend with. They can no longer rely on just simply lifting tax rates to extract what tax revenues they require. We believe that the South African economy is already experiencing the very top bit of the Laffer curve. For those of you that don't know, the Laffer curve gives you a sense of marginal return for every tax increase that one pushes through. Eventually, you get to a point where if you start increasing taxes beyond the capacity for the private sector to be able to absorb it, you land up collecting less in the way of tax revenue. So every time the tax revenue to GDP ratio has risen beyond the 25% mark, it hasn't been sustained. If one has a look at what happened in 2009 when fiscal policy was applied to try and dig South Africa out of that hole, look at what followed, a huge contraction in that tax revenue to GDP. That's what that crisis looked like. We believe that we're going to see a similar result this time around, which ultimately means that that South Africa's GDP collapse is going to result in a fairly substantial moderation in tax revenues. So South Africa's budget stress indicators are currently very, very elevated. And if one has a look at the Bernal's ratio, which is a barometer we often utilize to give us a sense of how comfortable or not a country is with its fiscal position, well, South Africa is in the danger zone. We have shifted into that danger zone, which typically is associated with periods of hyperinflation. Now, I don't mean to sound overly dramatic in highlighting this, but there's very good reason why this happens. Typically, what you find is when a government heads into a fiscal position which is unsustainable, often it requires the central bank to step in and help monetize that debt. That monetization of debt is ultimately the trigger that leads to that hyperinflation. Now, South Africa might not be as far away from that position as one might think. Although I'd like to believe that there are level heads at the Reserve Bank, which I believe there are, that will refrain from heading down that path, I'm less certain that our a political leadership has the foresight to understand this properly. Bearing in mind as well that the Reserve Bank has already stepped in with a form of QE light. In other words, they have already monetized some debt. They've sold it up until now as being a function of doing what they could to normalize activity in the South African bond market. But it's a hop, skip, and a jump to go from there into full-blown QE, which is where the probability of hyperinflation as a potential outcome becomes a lot more realistic. We're not there yet, but I'm highlighting this to give you a sense of just how precarious the fiscal situation in South Africa has become. And unfortunately for South Africa, it's not just about a fiscal crisis and austerity that needs to be navigated. It's also about the other crisis that the country is facing, and that's electricity shortage. So if one has a look at the energy availability factor, which is the blue line, in other words, how much energy is available for the economy to use, it has been on a steady downward trajectory. Eskom is doing everything that they're trying really hard to try and stabilize that and to turn that blue line around such that it starts marching higher. But so far, their efforts have been unsuccessful, and so we have a problem on our hands in the sense that by the CSIR's own projections, it would appear that load shedding is going to be a feature of this economy for a long time to come. This is their projection. If you have a look at the left-hand chart, you'll see the capacity shortage, which is those black bars, lasts well into 2025. It's only then that we start to get some new power stations coming on stream, which can alleviate some of that pressure. But between now and then, I think we need to get used to the idea that load shedding is going to detract from economic growth. And so that too counts against the kind of economic recovery or the shape of the economic recovery that South Africa is going to experience. So it's not just about the permanent damage that got done through COVID. It's also about the impact that Eskom and electricity is going to have on this economy. But Reserve Bank has responded, and we wait and see whether or not they're going to cut interest rates still further this week. They have behaved quite out of character. Typically, the Reserve Bank would not be cutting in an environment where inflationary pressures and money supply growth and the likes are starting to tick back up, and where fiscal policy is as dangerously loose as it is at the moment. So you wouldn't expect to see the Reserve Bank cutting rates so aggressively, but such has been their concern about the economic recovery and the prospects for the economy and unemployment that they've done so regardless. Inflation up until now has allowed them to do so, but as you see from the blue line, ETM's CPI risk index is now starting to rise, which is a danger signal to the Reserve Bank. Excuse me. It suggests that roughly 9 months from now, the inflation picture might look substantially different. And so what we may have at the moment is being a little bit of flexibility to be able to cut interest rates as a result of low inflation might very well reverse through the first and second quarters of next year. So fiscal risk is high, and it's been priced into South African bonds. And again, this portends some element of austerity that's going to have to be applied if we're going to get the interest on South Africa's longer-term debt to start moderating again. So that big spike that you see in the red and the blue lines gives you a sense of how much higher the bond yields further out the curve are relative to the short-dated debt, and it gives you a sense of just the level of premium that is being paid by this government to finance itself in the longer-dated bonds by virtue of the fact that they're running a very imprudent fiscal policy. So monetary policies had to pick up the slack, but there's only so much that monetary policy can do. And we believe that it is approaching the bottom of the cycle. So we don't know that there's that much more left in this. perhaps another rate cut, but that really would be pushing the limits of what the Reserve Bank is capable of doing right now. And so prospects for the Reserve Bank are that they are likely to enter a period of monetary stability insofar as their policy is concerned over the next 6 to 9 months, and that in itself gives it time to assess everything that it's done and the very aggressive stance that it's taken up until now. But terms of trade, thankfully, have improved for South Africa, and this is a positive. So we've got support from the monetary authorities. We've also got support from the financial markets more generally, as well as reduced imports. I'll get onto that in the next slide. But what we have here is a strong improvement in South Africa's terms of trade, up to the highest levels we've seen since 2016. That's partly a function of oil prices remaining subdued and a function of commodity prices remaining more elevated. But that certainly is good news for South Africa. And so it's not surprising that South Africa's current account deficit swung back into surplus before going into a slightly smaller deficit in the most recent data. But we anticipate that we should get used to the idea of smaller current account deficits out of South Africa and the odd swing back into surplus. That really is a function of the South African economy not doing particularly well. So we need to be careful about getting too excited about the fact that South Africa is now living more within its means. At this stage of the game, the country is living more within its means, which does promote a little element of stability, but it's doing so at the expense of economic growth, or rather as a result of a reduction in economic growth, which has reduced the demand for imports, has reduced the payments of dividends that get repatriated abroad, as well as coupon payments. We've seen a tremendous outflow of foreign investors into South African bonds over the last 6 months. So the big elephant in the room, insofar as South Africa is concerned, is its fiscal position. It has to be rectified. Fiscal risk, as reflected in this particular chart, these are scores out of 10 on the left-hand side. You can now see sits comfortably below 2 out of 10. That's a fail in everybody's book, and so that needs to be the factor that gets rectified. We are undoing a tremendous amount of monetary rectitude in the hope that easier monetary policy can buffer South Africa against this very low growth environment that it's experiencing right now. But in so doing, in reducing interest rates as aggressively as they have, the Reserve Bank has foregone some of its rectitude in the hope of producing growth, but it can come at the expense of volatility in financial markets, most notably the rand. So ranked out of a country sample of 22, we see that South Africa in the very right-hand fiscal rectitude bucket now ranks second from the bottom. The middle bucket, which is monetary rectitude, is a little disappointing for me to see, because South Africa used to be first or second insofar as this measure is concerned. It slipped right down into the bottom third. If you want to see how well South Africa did, just have a look at the 3-year average within that monetary rectitude bucket, and you'll see that it had a score of 6.3 out of 10. Look up and down that column and you'll see that is the best reading of the lot. So South Africa used to have a tremendously prudent monetary policy. We've given up some of that in the hope that we can try and support growth. Whilst I can understand that, given the context of the big slump in economic growth, I think one needs to be cautious in anticipating that it gets sustained for indefinitely. So South Africa's fiscal trajectory is what we've got to focus on, and trying to understand what the economic growth looks like, specifically with related to South Africa. Debt to GDP ratios are likely to rise. Currently, South Africa is on that blue line, if one has a look at the top left chart, to rise to 80% debt to GDP this fiscal year, closer to 90% the next fiscal year, and very rapidly heading towards 100% or more within 3 years. That, against the backdrop of very high interest rates, is quite simply unsustainable. And so South Africa is in urgent need of some drastic reforms. Hence, Finance Minister Tito Mboweni coming out on the newswires repeatedly saying this needs to happen, and it needs to happen now. And so far as the supplementary budget was concerned, they produced that red line. So they would like us to believe that with active management of the fiscus, that they can move from the blue line to the red. But look at those numbers. You're still talking about levels north of 80% debt to GDP, rising closer to 90 against the backdrop of high interest rates. So again, it's a fairly unsustainable picture, and demands that there's going to be some fairly dramatic reforms that need to be implemented. I'm mentioning all of this because those reforms, as they do get implemented, at least initially, are going to take some form of austerity. Either they're going to need to shrink the public sector wage bill, or they're going to need to privatize, or they're going to need to just cut down the size of government more holistically. One way or another, it's going to be tough times for those that are exposed to the public sector. But it has to be done, because the budget deficit, as you see on the right-hand chart, cannot continue at these levels. And in fact, we think that that budget deficit forecast is optimistic. If you have a look at the table at the bottom, and you look under the 2020 column and the real GDP growth figure of -7.2, we think once more that is optimistic. Even the IMF has a bigger negative number than that, and Mboweni has come out and so far and said that he believes that the picture is worse than what they had originally anticipated. So the shortfall is a further 300 billion over and above the 300 billion plus shortfall that they had originally penciled in. It's a colossal amount of money. It's a big hole to plug. And so it ultimately leaves South Africa in the unenviable position of having a currency that's undervalued. That's the vertical line, the degree of overall undervaluation. The horizontal line shows the degree of resilience to the far right versus fragility on the far left. Where you don't really want to be is the bottom left corner. Now, a lot of countries find themselves there, and that's been obviously the result of COVID, but some have been impacted a little more than others, and South Africa has been hurt, and hurt hard. So South Africa not in a particularly good position, but a recovery does appear to be underway. So I think if I had to end this presentation to give you a sense of what I'm anticipating, we do get an initial bounce back. It gives way to reality that follows, partly because fiscal policies get unwound, austerity starts to get implemented, and what growth starts to flow thereafter as households, businesses, and governments try their damnedest to pay down debt is a trajectory of growth which is a little more shallow. It means that South Africa might take up to 4 to 5 years to get back to pre-COVID levels. That's a substantially different picture to what's happening in the rest of the world. But I believe that this stylized ugly W, if you like, is probably the most realistic expectation of how we think that not just the global economy, but what those global economic forces are going to be, not just on South Africa, but on sub-Saharan Africa as well. And so with that, Quinn and Eric, I'd like to hand back over to you. I'm happy to take some questions at this